Mark Connon is the CEO at Cathay Conning Asset Management. He now joins us on the show from Hong Kong. Good morning, Mark. First up, what kind of money do you see coming to India in the reallocations within Asia Pacific, with some money being booked out of Japan?
Well, certainly we're seeing flows out of Japan. One of the effects of the new policies that are being suggested by Abe's government and then reinforced by the Bank of Japan is that investors are re-risking their portfolios. At the same time, of course, they're increasing their savings, which wasn't the intention. But where they are re-risking, some of that money, and a lot of that money, is flowing out of Japan into higher yielding currencies and into those emerging markets where there's a sense that they've underperformed and they can take advantage of potential price appreciation. And I think India tends to fall into that latter category, and it is starting to attract flows from Japan. And as we've seen of late, the Indian market has benefited from increased money flows.
Mark, hi, morning. What's your view on India, given that the Prime Minister's Economic Advisory Council has spoken of a growth target of 6.4% in FY14?
Well, certainly the economy bottomed out in the third quarter of last year, and we know that potentially the economy is capable of growing at a faster rate than that 6.4, 6.5%. However, in the near term, it's probably somewhat of a stretch because we still need to see some reforms go through, and as we know in India, that's never easy. But in the short term, the hot money coming in, or the flows coming in, will help shore up the current account and should allow the economy to improve. It may fall short of that target, though.
Okay, and what's the view on the Indian rupee?
I think the slightly longer term view is it's range bound. We don't expect on a 12-month view for it to really move significantly. In the short term, though, it's likely to be boosted by these inflows into the stock market. But then at the same time, we've got room for rates to be cut, with less inflationary pressure now coming through as a result of lower commodity prices, lower energy prices, and potentially, depending on harvest, the lower food prices.
Mark, also give us a sense of crude and gold prices. You know, the fall looks like it's been stemmed for now. And what levels then do you expect over the next 3 months?
Well, certainly with gold, we've seen somewhat of a recovery in the last few days, as we know. As the market fell very significantly, we've seen investors come back in and really see this as a buying opportunity. However, if we look at the broader macro picture, it's unlikely that this improvement is going to be sustained. If anything, it's a little bit like a bear market rally. So we could see gold come off further. And similarly, with oil costs, oil prices, we could see a slight weakening in that over the next 12 months. Although, again, near term, we've seen some strengthening.
And what's your view on China, which was expected to be the darling this year, given the valuations of the market there? Do you think China has disappointed investors?
Yeah, I think the Chinese equity market is really suffering from the effects of the stop-start policy of the authorities there. At each stage where they see weakness in the economy, they're sort of taking their foot off the brake and applying the gas to allow credit to expand. And then the subsequent month, as the data is published and we see that the credit expansion has been quite accelerated, suddenly we see additional policy measures to try and dampen down the enthusiasm for credit expansion and to try and curb any speculation. So this sort of juxtaposition of stop and start is not good for equity market prices. It undermines confidence and is unlikely to see a sustained push through of momentum, allowing both domestic and international investors to come in and really buy the market over a sustained period.
And what are you reading into the worries of the developed markets? Have they receded for good?
If you mean here in the sense of global growth, we do see global growth continuing to fall short of earlier expectations. We've seen IMF, World Bank, whichever authority you point your finger at, they've all been reducing their forecasts for growth both this year and next year, and that's really as a result of slower growth in China, which has been forecast for some time, although there clearly was an over-expectation of how quickly the economy would recover. And on the back of renewed recessionary fears in Europe, where the imposition of the single currency is still very much hampering effective policy, which is channeling credit to those who need it, which is the small and medium-sized businesses.
All right, and finally, is there a focus on US and Europe to buy stocks with emerging markets exposure? By that logic, should investors in India and Asia look at companies with exports or a global footprint?
Well, I think exports are going to continue to prove difficult. The global trade position and picture is quite tough, and if anything, we've seen stocks increase amongst a number of producers, particularly in China and Korea. And then if we look at China, we've seen those stockpiles reduce, but at lower prices, which if anything is deflationary for the global economy and doesn't really promote ongoing trade expansion. So certainly steering away from exporters at this stage and focusing more on consumption, domestic consumption. We are expecting to see sales growth across this region on the back of lower energy prices, lower food prices and rather muted inflationary pressure.
All right, Mark Carnan, we'll let you go on that. Now, thanks very much for joining in with your thoughts there.